Hi, today in this lecture we will sum up both the strategies, that is hedging risk reversal and bullish risk reversal. Now let's start with hedging risk reversal. Now let's presume today you bought the stock at 59.25. Okay, it goes up and crosses our Bollinger Band, so we know that it's going up. Okay, good. Let's move with the trend. It goes up. Now this is the first day that the Bollinger Band contracts right here on the top, and this is the second day. Now we know Bollinger Band is contracting, and when it does contract, it tells you that the stock usually doesn't go up or doesn't go down. It's in a confusion phase. So if it is in a confusion phase, then we have to remember, we have to take a decision. Otherwise, all the profit that we have generated from, let's say, $60 to this price of 62.43 will be lost. So how do we do it? The first is the put option. We put the put option right here on this top. Now, as you remember, I told you that we have to put the put option below the Bollinger Band, lower Bollinger Band. But as the Bollinger Band is contracting, so we believe that the price will that the Bollinger Band will contract and reach beyond this green line. Let me turn it into a red line. So we believe that the Bollinger Band will contract and go above this red line. So we know that this red line should not be crossed. Now if you bought it at 60, we are putting in or put option at 61.37. Let's say 61.50, right? Because strike prices are usually round numbered, so we won't be getting at 61.30. So we are putting it at 61.50. Now comes the call option. We are putting the call option at a far higher price of, let's say, 66. Let's turn it a green line. So if it goes to 66, we sell our stock to 66. If it goes to 61.50, then we can certainly claim or put option and get out, right? Number one. Now what happens next? Let's see. One day, wait a minute, let me put it here. On this day, we put the put option and call option, right? 2 day, 3 day, 4th day. Now on the 4th day, if you look at it, our Bollinger Band has crossed our line. So now if the price drops below the Bollinger Band, we know that the change in trend is happening. But we will be only able to sell our stock on this red line. We cannot sell it above this. Okay, so it's 1, 2, 3, 4, and 5th, 6th, 7th, 8th, 9, 10, 11, 12, 13, 14, 15, 16. Now it's going up, and our top number, the top line at 66 could be achieved. Now if you look at it, we traded it right here on 3rd January 2017. So it's 3rd February 2017 when the option will expire, right? 1 month from now. Let's see. It goes up, down, down. Is it 3rd February? No. Down. This is 1st February. Down. This is 2nd. And this is 3rd February. Right here, our options contract will expire. We are not making money. That is, it has not touched the top bar or the lower bar. But we have made the profit in the premium of options. Now right here, we can suddenly trade again the same options on top and on bottom, the same strike prices. Reason being, because we believe 65 is a good number to get out. We bought it at 60. So 66 means 10% profit. Huge profit. And if it goes down, then this red line, that is the put strike, will get us out. And if you look at it, this number is still below the Bollinger Band. So it's again not bad. Let's see what happens next. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Now if you look at it, this D means result came in. And even though the result were like 39 cents dividend, not bad, but still it's going straight. So, or like first option expire on 3rd February. Now let's say on 3rd March or second options will expire. If you look at it, it's still straight. And 3rd March is right here. Again it expired. Now, if you look at it, the real like game, 1, 2. The real game is right here. Once we traded initially, we were getting the price of 62. This is the closing price, 62.58. But right here, on this 3rd March, that is 2 options expire worthless, we are getting price of 64.25. So $2 is automatically be made. We are like more in profit. And we can still claim the same prices or increase the prices to this level and increase it further high to, let's say, 67. So this is the number one thing to remember, that as the price moves up and Bollinger Band starts to move up, if you look at it, it's moving up. Let me zoom out to show you. It was contracting here, but now right here, my mouse where I am putting it, you can see a dotted line being generated. If you look at it, now the Bollinger Band lower band is near the top band of Bollinger Band previously. So it has moved up, and our profit target can also move up. So our strike prices will move up. We can put the like top call price at 67 rather than 66. So $1 more is gained. And our lower put option price of 62 has increased to 62.55, 62.50, because 55 is not round number, and usually strike price is a round number in options. So if you can look at it, the Bollinger Band also tells us the direction. So we keep on increasing it on expiry, and we get to keep a good profit, because still this red line is below the Bollinger Band. We can even increase it further up. 63. And we can even increase that, the top one, from 66 to 66.50, 67.50. Now let's see what happens next. It's 3rd March we traded, so the next option expires on 3rd April. Now let's see. Still goes straight. Still goes straight. Still goes straight. And expires worthless. So we can play this game again and again and again and again without any problem. And we are still making profits. The best thing. Because in like premium profits, we are gaining something in return. And as you can see, our like put option price, that is our sell price, if it crashes down, gets increased slowly and gradually. So we get to get more profits, and we get to keep the stock. So if it goes down, our lower put option price has increased further, $1 up, $2 up. And our like top call price have also increased $1.50 up. So we are getting more profit in return with the hedging strategy. If you would have hedged it, if you would have just sold the stock initially, then you would have been out of the market. And if you like Microsoft, then you'll be always thinking to enter it again. Now the price, as you can see, for the past many months, it's going still straight, not going up, not going down. So if you would have bought it, you would have again the risk of it crashing down. So your risk will stay into your mind. But with this hedging technique, the risk will be thrown out and your profits will start to increase. How? Because we can suddenly increase our lower put option price bit by bit. And the top call option price, strike price, can also increase bit by bit. So basically you're getting more in return with no risk. Because you already know your risk is defined at $63. That is the put option on this red line. This is the strategy. See? Now let's move to the next number. Bullish risk reversal. How does that work? Because if you look at it, this is like going straight. And hedging tells you how it works. Now right here, the price has really crossed up. See? It has gone above the Bollinger Band. So right here, the bullish risk reversal strategy can come in. On the top, you can put in the call option that says that you can buy the stock on this rate if the price goes up. And you put a put option below the Bollinger Band. So if the price goes lower, it starts to act like a short sell. So I won't recommend really close to the Bollinger Band. I would recommend a bit of a difference. A bit gap in between the lower Bollinger Band and your put option. Now let's see what happens next. One day it goes top, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. If you remember, we traded on this day. This is 21 April, right? Let's presume we have made this trade with 30 days expiry. So 21st April means 21st May. It still goes up. This is a result day. You can see this T. It says dividend was announced. 39 cents. Not a bad result. And this is 21st April, so 21st May would mean expiry. This is 16th May. 17th, 18th, 19th. And boom. Wait a minute. Yeah, on this day it will expire. And on expiry we can certainly claim the stock right here at, let's say, 66.75, and you can simply sell it at 68.45. This close C is for close. So on this day it's 68.45. So 68.45 means you bought it at 66.75. So approximately $1.50. That's approximately 2.5% profit without any problems. The best part, you simply bought it, and as it crossed the Bollinger Band on top, you knew it's going up. And on expiry date, you simply bought it here and sold it here. Boom, profit booked. No problem at all. And now the question comes in, will you be trading the second strike prices? No. Reason being, in a bullish risk reversal strategy, you need the price to go up. But right here, if you look at it, the Bollinger Band has started contracting. So if it is contracting, it tells you that you can put a hedging risk reversal strategy, but not a bull risk reversal strategy. So the point is to remember what the Bollinger Band is telling you. Because if it is telling you that it's a hedging risk reversal strategy, then you cannot simply put a bullish risk reversal strategy. You have to wait for it. You cannot simply go all out. You have to wait. And the key to success in risk reversal strategies is patience. Because if you look at it in the past, Right in this lecture, we discussed that the hedging risk reversal strategy went on and on and on for 3 months. So you have to wake up every day and see the price at the same range. It is increasing, and so is your strike prices, but it's increasing at really slow pace. So every day you wake up and you see that the Microsoft stock is stuck. You cannot do anything. In a bullish risk reversal, it does go up, but you have to wait till the expiry date. And the game plan acts as you have to make sure that you are buying it at the correct moment. Because if you buy it right here, let's presume you buy it right here, you will get stuck. And your lower, the short position put option, will always be the danger that what if the stock suddenly goes down, then you will have to make a far higher loss. And my strategy is always try to make a trade without any odds of loss. And as you can see, I am suggesting you trades by telling you what your odds are. Once we are trading it above the Bollinger Band, then we have the odds of success in our favor. And because odds of the success are in favor, we are making money. In a hedging situation, we designed it in such a way, as you have seen in this lecture, that we knew that okay, if it goes lower, we will sell it. But as the price suddenly goes up and the Bollinger Band moves up, our strike prices also comes up 50 cents, $1, $1.50, up. So as the strike price moves up, our risk level is the same. It reduced to zero because we know on the lower put we can get out. But our price is increasing, and so we are getting more in return of our through our hedging strategy. And the real thing is in bullish hedging strategy is you should never apply the bullish hedging strategy once the price is within the Bollinger Band. If you have applied it earlier and the price comes into the Bollinger Band, not a problem. Because till the time it comes in, many days have passed and your expiry date is far nearer. So you know it will expire. But if you apply it right here, then your expiry date is further away. And the risk is far higher because the price can suddenly break the Bollinger Band and go lower. And once it starts to go lower, then this red put option will start to act as a short position and will start to give us huge losses. So this is the strategy. And that's what I want to tell you about. If you look at it, the price continues to go up, but continues to move up. Why? Because if you would have squared it right here somewhere, you could have again bought it right here for bullish risk reversal. This red line acts as rising prices. And this red line would have acted as or stop or short position. If the stock goes from top to bottom, then below the Bollinger Band it will act as a short position. And as it has crossed above the Bollinger Band, so we are really bullish. It is going up. And if we traded right here, and this is 30th May, so we know 30th June would be the expiry date. Let's see. Now this date is 27th June. This would be 28th June. We bought it right here. This green line acts as a buying call option. That is, we can buy the stock right here. And this red line is a danger line. If it goes below this, we start to generate losses. Now just look at it right here. It's approximately a month. This was 30th May. Let's see where it expires. 28, 29. This is 30th June. 1 month since that buying period. Now where it is moving? it is moving within the band. So both options expires worthless. And we get to keep a smaller loss of the premium paid. If it is a net debit transaction, if you can find a net credit transaction where you are getting paid for it, the best thing. But even if it is a net debit transaction, you get to keep a far lower loss. Not a problem, 30 days have passed. And you got a like smaller 10 cents loss. No problem. And the best part, you could have claimed it on any day. Once it crossed up, you could have claimed it on any day and sell it. Just claim this number. This is 7050 or 7065. Let's say 7075. You can claim it right here and sell it right here. That's 7282 right here. Sorry, 71.95. So you made a $1.25. If you would have claimed it right here, let's presume you don't claim it. You wait till the expiry date. Then what would have happened? It would have come in the Bollinger Band. And once it came in the Bollinger Band, this is the really important thing. Once the price came in the Bollinger Band and the Bollinger Band started to contract. Example right here, the top Bollinger Band number is 7312. It drops to 73. It drops to 72.90. That's 3 days in a row that it's contracting. And you know the price is now contracting because the Bollinger Band is contracting. And the price is below your like green line. So this is a telltale sign there is something wrong. You bought it as a bullish risk reversal, which means your like psychology or your thinking was that the price is bullish. But as the Bollinger Band has started to contract, then it means there is something wrong. And your expiry date is also like half days have passed right here. And you have to make a decision because within the next 15 days, the option will expire worthless. So what do? If the price jumps up, you suddenly claim this option, sell the like stock at the top price, and square this put option. That is, you have written this put option, you simply buy a put option. Boom, this squared, and this bought right on this line at let's say 72.75 and sold at 77.87. Boom, you got 10 cents that pays up the premium commission and you're out without any profit or loss. And even if you wait till the expiry date, then even it's not a problem. Why? Because the risk is only the premium, like net debit premium. The premium that you paid from your pocket, which usually comes down to 5-10 cents, 15 cents max. Around, let's say you have 10 contracts, around $100 for 10 cents. Not bad. And if it goes up on 10 contracts, you would have made huge money. Why? Because as we discussed earlier, you made $2 profit. Now on a 10 cents, it would have meant $2,000 in profit previously. Just the trade that we made 5 minutes earlier. So it's really an important strategy.